Welcome back, everyone. Today, we are dissecting the latest financial report from a giant in the Indian mining sector, NMDC Limited.
That's right. NMDC, or National Mineral Development Corporation, is a Navratna public sector enterprise under the Ministry of Steel. Their primary business is iron ore mining, but they're also involved in exploring other minerals like copper, rock phosphate, limestone, and more. They have significant mining operations across India. The investor presentation also highlights their investments in subsidiaries and JVs like JKMDC, NCL, BRPL, KVSL, and even international ventures like ICVL and Legacy Iron Ore in Australia. Quite a portfolio.
Indeed. So, it looks like NMDC has released its audited standalone and consolidated financial results for the fourth quarter and the full financial year ended March 31st, 2025. The Board of Directors approved these results in their meeting on May 27th, 2025. We'll be looking at both sets of numbers today, standalone and consolidated, to get the full picture.
Absolutely. It's crucial to look at both to understand the core company performance and the performance of the group as a whole.
Great. Let's kick off with the standalone financials. How did NMDC perform in Q4 FY25 on the revenue front, especially when we compare it year over year and quarter over quarter?
Okay, for the standalone entity, in Q4 FY25, revenue from operations stood at 6,953.13 crore rupees. Comparing this to Q4 of the previous year, which was 6,475.27 crore rupees, that's a healthy increase of about 7% year over year. Now, looking at quarter over quarter performance, revenue in Q4 FY25 was up from 6,530.82 crore rupees in Q3 FY25. That's a sequential growth of around 6%, so positive on both fronts for Q4 revenue.
Good start on the revenue. What about EBITDA, or earnings before interest, taxes, depreciation and amortization for the standalone business in Q4?
For standalone EBITDA in Q4 FY25, NMDC reported 2,538 crore rupees. Year over year, this is slightly down by about 1% from the 2,554 crore rupees reported in Q4 FY24. Sequentially, comparing Q4 FY25 to Q3 FY25, EBITDA fell from 2,783 crore rupees. That's a 9% decrease quarter over quarter. So revenue up quarter over quarter, but EBITDA down quarter over quarter is something to note.
Interesting divergence there. Let's move to profit before tax, or PBT, on a standalone basis for the quarter.
Standalone PBT for Q4 FY25 was 2,350.86 crore rupees. It's important to note there were no exceptional items in this quarter for FY25. In Q4 FY24, PBT after exceptional items was 2,405.29 crore rupees. So, on a year-over-year basis, PBT is down by about 2%. Quarter over quarter, PBT for Q4 FY25 is down from 2,630.70 crore rupees in Q3 FY25, which is a decrease of about 11%.
And the bottom line for standalone profit after tax, or PAT, for Q4?
Standalone PAT for Q4 FY25 came in at 1,496.35 crore rupees from continuing operations. This is up by about 2% year over year from 1,462.29 crore rupees in Q4 FY24. However, sequentially, PAT is down significantly by about 23% from 1,943.84 crore rupees in Q3 FY25. That's a noticeable drop from the previous quarter.
What about the full year standalone performance for FY25? Give us the highlights for revenue, EBITDA, PBT and PAT compared to FY24.
For the full financial year FY25, standalone revenue from operations was 23,668.32 crore rupees, up by 11% from 21,293.81 crore rupees in FY24. Standalone EBITDA for FY25 before exceptional items stood at 9,847 crore rupees, which is a strong 13% increase from 8,709 crore rupees in FY24. Standalone PBT for FY25 with no exceptional items was 9,297.67 crore rupees. This is up 16% from 8,013.30 crore rupees in FY24, which had some exceptional expenditure. And finally, standalone PAT from continuing operations for FY25 was 6,693.53 crore rupees, a solid 19% increase from 5,632.88 crore rupees in FY24. So a pretty good year overall for the standalone entity.
That does sound like a strong annual performance. Any significant other income we should be aware of in the standalone results?
Yes, for Q4 FY25 standalone, other income was 490.78 crore rupees, up from 417.44 crore rupees in Q4 FY24. Sequentially, it was up from 374.46 crore rupees in Q3 FY25. For the full year FY25, standalone other income was 1,590.24 crore rupees compared to 1,355.34 crore rupees in FY24. This component definitely provides a bit of a cushion to the bottom line.
Now, let's switch gears to the consolidated financials. How do these numbers look for Q4 FY25 and the full year FY25, starting with revenue?
All right. For the consolidated entity in Q4 FY25, revenue from operations was 7,004.59 crore rupees. Year over year, that's an increase of about 8% from 6,489.31 crore rupees in Q4 FY24. Quarter over quarter, consolidated revenue in Q4 FY25 was up by nearly 7% from 6,567.83 crore rupees in Q3 FY25.
And consolidated EBITDA for Q4 FY25?
Okay, calculating the consolidated EBITDA for Q4 FY25, PBT was 2,337.88 crore rupees, plus finance costs of 64.93 crore rupees and depreciation and amortization of 140.88 crore rupees. That gives us a consolidated EBITDA of roughly 2,543.69 crore rupees for Q4 FY25. For Q4 FY24, PBT before exceptional items was 2,388.73 crore rupees plus finance costs of 21.40 crore rupees and D&A of 110.64 crore rupees, giving an EBITDA of around 2,520.77 crore rupees. So, year over year, Q4 consolidated EBITDA is up by about 1%. Sequentially, for Q3 FY25, PBT was 2,583.8 crore rupees, finance costs 60.57 crore rupees and D&A 102.68 crore rupees, making EBITDA about 2,747.1 crore rupees. So, Q4 consolidated EBITDA is down around 7% quarter over quarter from Q3 FY25. Oh, similar trend to standalone EBITDA here.
Understood. What about consolidated PBT for the quarter?
Consolidated PBT for Q4 FY25 stood at 2,337.88 crore rupees. This is slightly down by about 1% year over year from 2,358.88 crore rupees in Q4 FY24, which was after an exceptional expense. Quarter over quarter, consolidated PBT is down by about 9.5% from 2,583.85 crore rupees in Q3 FY25.
And the consolidated profit after tax for Q4. We're interested in the profit attributable to the owners of the company.
The consolidated profit after tax, non-controlling interest, and share of profit or loss of associates or JVs, essentially PAT attributable to owners for Q4 FY25 was 1,477.68 crore rupees. This is up by about 4.6% year over year from 1,412.67 crore rupees in Q4 24. Sequentially, this PAT is down by about 21% from 1,881.96 crore rupees in Q3 FY25.
Now for the full year consolidated picture for FY25, revenue, EBITDA, PBT and PAT.
For the full year FY25, consolidated revenue from operations was 23,905.52 crore rupees, an increase of 12% from 21,307.85 crore rupees in FY24. Consolidated EBITDA for FY25, calculated as PBT of 9,143.89 crore rupees, plus finance costs of 177.68 crore rupees and DNA of 420.42 crore rupees, comes to approximately 9,741.99 crore rupees. For FY24, PBT before exceptional items was 8,234.81 crore rupees, plus finance costs of 78.24 crore rupees and DNA of 350.66 crore rupees, giving an EBITDA of around 8,663.71 crore rupees. So, consolidated EBITDA is up by a strong 12.4% year-over-year. Good growth there. Consolidated PBT for FY25 was 9,143.89 crore rupees, up 15% from 7,952.66 crore rupees in FY24, which was after exceptional items. And the consolidated PAT attributable to owners for FY25 was 6,541.98 crore rupees, a significant 17% increase from 5,575.06 crore rupees in FY24.
That's a comprehensive look at the numbers. What about earnings per share, EPS, considering the bonus issue NMDC had?
Right, that's important. For standalone EPS for Q4 FY25, the basic EPS was 1.70 rupees compared to a restated 1.66 rupees for Q4 FY24. For the full year FY25, standalone basic EPS was 7.61 rupees, up from a restated 6.41 rupees for FY24. On the consolidated side, basic EPS for Q4 FY25 was 1.68 rupees compared to a restated 1.61 rupees for Q4 FY24. For the full year FY25, consolidated basic EPS stood at 7.44 rupees, up from a restated 6.34 rupees for FY24. The notes confirm these EPS figures are post-bonus adjustments.
Okay, let's talk profitability. Any specific insights on EBITDA margins या net profit margins? How do standalone and consolidated margins compare?
For standalone Q4 FY25 with EBITDA of 2,538 crore rupees on revenue of 6,953 crore rupees, the EBITDA margin is about 36.5%. The net profit margin, PAT divided by revenue, is around 21.5%. For consolidated Q4 FY25 with our calculated EBITDA of roughly 2,543.69 crore rupees on revenue of 7,004.59 crore rupees, the EBITDA margin is about 36.3%. The net profit margin, PAT attributable to owners divided by revenue, is around 21%. So the margins are quite comparable between standalone and consolidated for the quarter, and they are quite healthy. For the full year FY25, standalone EBITDA margin was around 41.6% and consolidated EBITDA margin was about 40.7%, both showing strong profitability.
Were there any significant exceptional items this year compared to last?
For FY25, both standalone and consolidated results do not show any exceptional items. However, in FY24, there was an exceptional expenditure of 282.15 crore rupees reflected in both sets of accounts. So FY25 results are cleaner in that regard without exceptional items impacting the PBT.
Let's touch upon the balance sheet. Any key highlights from the standalone or consolidated balance sheets as of March 31st, 2025?
Looking at the standalone balance sheet, total equity stands at 29,579.18 crore rupees, up from 25,405.78 crore rupees last year. Total assets are 40,827.73 crore rupees. Key non-current assets include property, plant and equipment at 2,613 crore rupees and significant financial investments and other financial assets. On the consolidated side, total equity attributable to owners is 28,816.59 crore rupees plus NCI of 11.41 crore rupees, making total equity 28,828 crore rupees approx, up from 25,362.83 crore rupees plus NCI. Total consolidated assets are 41,006.88 crore rupees. The structure is broadly similar, with the main difference in equity reflecting the NCI and any consolidation adjustments.
How about cash flow and dividends?
The standalone cash flow statement shows net cash flow from operating activities for FY25 at 1,577.36 crore rupees, which is significantly lower than the 7,439.43 crore rupees in FY24. This was mainly due to a large increase in trade receivables. Net cash from investing activities was positive at 704.86 crore rupees versus negative last year, mainly due to changes in term deposits. Net cash used in financing activities was 2,224.35 crore rupees, largely for dividend payments. The consolidated cash flow statement for FY25 shows net cash flow from operating activities at 1,894.28 crore rupees, also down from 7,393.94 crore rupees in FY24, again impacted by working capital changes. Regarding dividends, the company declared an interim dividend of 2.30 rupees per share for FY25 during the year, and the board has recommended a final dividend of 1 rupee per equity share for FY25 subject to shareholder approval. So, a total dividend of 3.30 rupees per share FY25. Shareholders would like that.
Now, a crucial part, segment performance. NMDC has iron ore and then pellets, other minerals, products and services. How did these segments fare on a consolidated basis?
On a consolidated basis for Q4 FY25, the iron ore segment reported revenue of 6,350.49 crore rupees and a profit before tax and interest of 2,451.29 crore rupees. Segment assets stood at 20,922.95 crore rupees. The pellet, other minerals, products and services segment had revenue of 662.07 crore rupees and a loss before tax and interest of 18.20 crore rupees. Segment assets were 999.94 crore rupees. For the full year FY25 consolidated, iron ore segment revenue was 22,906.32 crore rupees with a profit before tax and interest of 9,101.84 crore rupees. Pellet, other minerals, products and services segment revenue was 1,102.12 crore rupees with a loss before tax and interest of 292.81 crore rupees. Clearly, iron ore is the profit engine for NMDC. The other segment seems to be a drag on profitability, at least in terms of reported segment profit. Capital employed in iron ore is significantly higher too, around 14,935 crore rupees versus about 798 crore rupees for the other segment.
That's a stark difference. So summarizing the overall performance year over year, what's the big picture?
Year over year, NMDC has shown good growth in revenue and even better growth in profitability for FY25, both at standalone and consolidated levels. This suggests improved operational efficiency or better price realization for its core iron ore products. The absence of exceptional expenses in FY25 also helped the PBT and PAT comparisons. The physical performance data in their presentation also shows Q4 production at 133.07 lakh tons, slightly up year over year, and sales at 126.68 lakh tons, also up year over year, and a best ever for Q4. For the full year, production was 440.72 lakh tons, second best, and sales were 444.04 lakh tons, second best.
Now the reports always come with a lot of notes. Were there any particularly significant notes or events disclosed that investors should be aware of? This often where the real story lies.
Absolutely. And NMDC's notes are quite telling. Both standalone and consolidated results have extensive notes, and many are highlighted in the auditor's report as emphasis of matter. First, there's the Karnataka Mineral Rights and Mineral Bearing Land Tax Bill 2024. It proposes a retrospective levy, and NMDC estimates a potential liability of a whopping 13,975.07 crore rupees. It's pending presidential assent and is disclosed as a contingent liability. This is a huge overhang. Second, dues from NMDC Steel Limited (NSL) arising from the demerger amount to 2,151.39 crore rupees, plus trade receivables of over 3,655 crore rupees. Management is confident of recovery due to NSL's operational scale-up and SAL marketing tie-up, but it's a large sum. Third, trade receivables from Rashtriya Ispat Nigam Limited (RINL) are around 4,049 crore rupees. A revival plan for RINL has been approved and management is confident of recovery, but again, it's a significant amount outstanding. Fourth, there's an advance of 639.61 crore rupees paid to Karnataka Industrial Area Development Board (KIDB) for Karnataka Vijayanagar Steel Limited (KVSL). The land is with KVSL, but the lease agreement isn't executed and business model evaluation is ongoing. Fifth, a demand of 1,623.44 crore rupees related to compensation based on the common cause judgment is sub judice. Sixth, a penalty notice of 1,620.50 crore rupees for alleged mineral dispatches without timely railway transit passes (RTP) is also sub judice. And finally, the notes detail the investment in Legacy Iron Ore Limited (LIOL) in Australia, which has resumed trading, and NMDC has subscribed to its rights issue. The net worth of LIOL is positive. Also, the company issued bonus shares in December 2024 in a 2:1 ratio.
Wow, that's a laundry list of significant financial matters and potential liabilities. This brings us to the auditor's report. What did Verma and Verma, the statutory auditors, have to say for both standalone and consolidated results? Any qualifications?
Okay, this is critical. For both the standalone and consolidated audited financial results for the year ended March 31st, 2025, Verma and Verma have issued an unmodified opinion. That means they believe the financial statements give a true and fair view. However, and this is a big however, they have included an extensive emphasis of matter section in both reports. This emphasis of matter section does not modify their opinion, but draws attention to those very significant notes we just discussed. 1. The Karnataka Tax Bill and the potential 13,975 crore rupees liability. 2. Recoverability of dues from NMDC Steel Limited (NSL). 3. Recoverability of trade receivables from RINL. 4. The status of the advance paid for KVSL. 5. The demand related to compensation under the common cause judgment. 6. The penalty concerning railway transit passes. 7. The financial position of Legacy Iron Ore Limited. This one is more of an update in the notes rather than a risk in itself for the auditor's emphasis, but it's part of what they highlight.
So, an unmodified opinion but with a very strong spotlight on these major uncertainties. What are the implications for investors?
The implication is that while the reported numbers are technically clean from an accounting perspective for FY25, no exceptional items for instance, there are massive potential future financial impacts lurking in these contingent liabilities and recoverability issues. The Karnataka Tax Bill alone, if it comes through, would be a huge blow. The auditors are essentially saying the accounts are fine based on current knowledge and accounting standards, but be extremely aware of these massive risks that could change the financial picture dramatically. For the consolidated audit, they also mention their reliance on the audit of 6 branches by other branch auditors and the audit of one foreign subsidiary, Legacy Iron Ore, by another auditor whose financials were restated by NMDC management to comply with Ind AS, and these adjustments were audited by Verma and Verma. They also note that financials for 2 subsidiaries, 2 associates and 3 joint ventures were unaudited and based on management certification. But some of these are not consolidated anyway due to reasons like being a Section 8 company or being under closure, as detailed in Note 17 of the consolidated results.
That's a very important clarification. So, considering all this, the financial performance, the segment contributions, the significant notes, and the auditor's emphasis, what's the outlook for NMDC and what are the key risks?
The operational performance, especially in the iron ore segment, has been strong in FY25, leading to good revenue and profit growth. The company is also rewarding shareholders with dividends. The outlook for iron ore demand will be a key driver. However, the risks are substantial and primarily stem from those items in the emphasis of matter. The potential tax liability from Karnataka is the elephant in the room. The recoverability of large dues from NSL and RINL, while management is confident, remains a monitorable. Any adverse outcomes in the sub judice matters, compensation, RTP penalty, could also impact financials. So it's a mixed bag. Good operational performance currently, but significant clouds of uncertainty on the horizon. Disclaimer: as always, we advise investors to conduct their own due diligence and consult with certified financial experts before making any investment decisions.
A very balanced perspective. So, to conclude our discussion on NMDC's Q4 and FY25 results.
In summary, NMDC has delivered a strong operational and financial performance in FY25, particularly from its core iron ore business, both at the standalone and consolidated levels. Profitability has improved and the company is shareholder-friendly with dividends. However, the emphasis of matter by the auditors cannot be overstated. The sheer scale of potential liabilities and the uncertainty around large receivables mean that investors need to tread very carefully and keep a close watch on developments related to these issues. The underlying business is robust, but the external financial risks highlighted are significant.
Excellent analysis, as always. That's a lot for investors to chew on regarding NMDC. And that's all the time we have for today. Join us next time as we unpack another company's performance. Don't forget to subscribe.